2026 so far, the US has seen about 47 IPOs already. The IPO companies include Jaguar Uranium and Agamab and others. The well-known ones like SpaceX, Anthropic, OpenAI still waiting, most probably the end of 2026. Investors are panicking because IPOs are suddenly popping up everywhere. We've all heard the old saying, when the IPO market heats up, the crash is near. So, is the bubble about to burst? I'll give it to you straight, not yet. Take a deep breath. We aren't there. At least, not today.
To figure out where we're headed, we have to look back at where we've been. Let's rewind. In 1999 alone, there were 486 IPOs in the US. In 2000, over 400 more. Some months had 50 or 60 new listings. It was a wild time. Many had no profits, some had no revenue, just a website and a dream. If you just added a com to your company's name, investors would practically throw money at you like it was confetti at a parade. Pets.com, gone in 9 months. Webvan raised $800 million, dead in 2 years. VA Linux popped 698% on day one. Why did it happen? 2 big reasons. First, money was easy. The Fed had cut rates after the Asian crisis and LTCM. Liquidity was everywhere. Second, narrative, something like, the internet changes everything, growth will never stop. Old valuation rules don't apply. Sound familiar? Now jump to 2021. This was the era of SPACs. Different story, same pattern, over 1,000 IPOs, more than 600 SPACs, $300 billion raised. What did this happen? It just repeats, zero rates, QE, stimulus checks. Rivian IPO'd at a $100 billion valuation, no real production yet. It wasn't just tech, it was everything. When liquidity floods the system, IPO multiply. The Federal Reserve was basically handing out free money. And Wall Street love it, they were busy selling everyone a beautiful dream. This dream was that new technology would solve every problem under the sun, from curing major diseases to fixing your bad haircut. But here's the secret. During those crazy years, the so-called smart money wasn't actually investing, they were exiting. They were cashing out. They were selling you a ticket to a party that was already winding down. It was the classic IPO frenzy. So the big question is, are we seeing the same thing in 2026? Around 47 IPOs so far. Mostly small caps, biotech, uranium plays, a few niche names. No giant tech debut, no trillion-dollar roadshows. Have not seen 500% day one spikes. And the big names, OpenAI, still private, Anthropic, still private, SpaceX, still private. In a true bubble peak, the best companies rush to list. Because valuations are insane. Right now, the real heat is in large-cap AI leaders. NVIDIA, Microsoft, Meta, they're profitable cash machines, high margins. This actually looks more like 1972, the Nifty 50, or 2018 mega-cap concentration. In 1973, people said, these companies never need to be sold. Coca-Cola traded above 40x earnings, Polaroid above 90x. They were real companies, just very expensive. That's closer to today. Not garbage IPO, but expensive giants, big difference.
Don't get me wrong. I'm not saying there's no bubble in AI stocks right now. We are definitely in the late innings of the game. The sun is setting, and the music is slowing down. You don't have to leave the party just yet, but you should definitely start moving closer to the exit door. So, the big question is, when should you make a run for it? You need to watch for these signals. First, if you start seeing pre-revenue AI startups going public with insane $50 billion valuations, that is a huge red flag. Run. Second, if your Uber driver, your barista, or your neighbor who knows nothing about investing starts giving you AI stock tips, it's time to run. When the junk stocks start trading like gold, you know the top is in. We aren't quite there yet. But you better keep your sneakers laced up and ready. So, how do we play this market? How do we protect our hard-earned money? Think of your portfolio like a house that's caught fire. You absolutely need a fire extinguisher. Here's your 2-step plan. First, you need to trim the fat. Start by selling some of those high-flying AI stocks that have already given you massive gains. Take some profits off the table while they're on the way up. Then, move that money down the food chain. Instead of betting on what I call hype AI, the companies with big stories but no profits, look for cash flow AI. These are the companies actually making money from artificial intelligence right now. In simple terms, move your investments from stocks with high PE ratios to those with low PE ratios. You're shifting from speculative growth to proven value. Second, buy the boring stuff. Yes, you heard me right. Boring can be beautiful in a volatile market. I'm talking about building a defensive foundation for your portfolio. Consider some solid ETFs for those. Juicy, consistent dividends that pay you to wait. You could also look at ETF, which is designed to help fight inflation and protect your purchasing power. And don't forget something like ETF XX to keep the cash flowing while the market wobbles. Look for companies with wide moats. These are businesses with strong competitive advantages that are incredibly hard to kill. Think of brands you use every day, services you can't live without. Remember, the goal isn't to be the richest person in the graveyard. The goal is to build and keep your wealth for the long run. It's about playing smart, not just playing hard. Stay smart and stay briefed on what really matters. If you want to stay ahead of the next market alarm, subscribe to Brief Wealth Signal.